This is Professor at MoneyPigTrading, a former PhD drug researcher and now a trader and a data scientist. And today we want to talk about SPAC, Special Purpose Acquisition Company, Corporation. It's been so popular, everybody's talking about it on Twitter, Reddit, social media, Discord. So we just wanted to have a brief tutorial about what it is and what you should know before you invest money in a SPAC stock. So just a really quick disclaimer, MoneyPigTrading is not a registered financial advisor. This presentation is only for education purposes. Please invest at your own risks, blah, blah, blah. So if you haven't followed us on Twitter, Jim Cramer, who's a very famous CNBC and the street runner and also an investor, he shut out our Twitter content, which is MoneyPigTrading. Feel free to make sure to follow us. Like Jim Cramer shouted out our Twitter. And also we have a Discord community. If you have interest, please check on www.moneypigtrading.com. And our Twitter, YouTube, and Instagram on MoneyPigTrading. And we just started a Chinese channel of YouTube. It's MoneyPigTradingZh. If you want to practice Chinese or you're a Chinese native speaker, feel free to follow us over there as well. So today the topic is Special Purpose Acquisition Company SPAC. So we actually made a YouTube video last week. We have a biweekly SPAC radar. Shouted out some most discussed SPAC names on Discord based on data mining 18,000 Discord servers. Basically, the most popular SPACs names are CCIV, KIU, CGRO, FMAC, and NPA. We'll put the link down below if you haven't watched it. So today the highlight is we'll define what is SPAC and what are the three different stages of SPACs. And what are the dilution factors and who holds the dilution bags and how to choose SPAC names. So what is SPAC? It's basically a blank check company to raise capitals through IPO initial public offering. And the goal is to acquire existing companies. The 2 years, basically a SPAC name will have 2 years to acquire a company, or they have to return the money to investors plus some interest fees paid to the investors. And the SPAC IPO investors, usually if you invest into it, you wouldn't know which company this particular SPAC is going to acquire. Usually they will have a list of companies they want to acquire, but they wouldn't unveil it because due to the legal complication. And for the acquired company, or we call the target company, SPAC usually provide a faster route for the company to be public than IPOs. Also, SPAC actually has another advantage is some companies, they cannot disclose enough information or attract enough investors through IPO. SPAC actually provide probably the only way for them to become public. And SPAC is often, if not always, start with $10 a share with the IPO price. So just to highlight, there's a really good SPAC study called the Sober Look at SPACs. A lot of these presentation numbers are cited from there. This is their link. And this study is not being peer-reviewed. That's my understanding, since it's published on SSRN. It's more like a conference paper publication. However, both Michaels, the others, are from well-known Stanford and New York University School of Laws. And also Emily, which I'm not sure about her affiliation, and also spent some time running some numbers, and I'm able to reproduce some of the numbers. Though MoneyPigTrading or myself do not have enough human resources to reproduce all the numbers reported in this study, which includes very extensive SPAC names throughout 2019 to 2020. So that's just some disclaimer that I should know. So what are the three different stages of SPAC? So based on this paper, there are three different stages of SPAC, and I just grabbed this figure from their paper. The first one is the SPAC has to IPO, initial public offering, and the public investors can now pay the money to buy the warrants or the shares, stock shares of the SPAC name. And once the SPAC actually find a target company to acquire, they actually will allow investors to redeem their shares. So that means those investors who can, either the private or public investors, they can have the right to choose like, okay, I don't want to carry the shares after the merger. I just want to either sell it to the public or just have a redemption. So based on this study, 66% of the shares on average will be sold to the public before the merger or being redeemed. So that means only about 34% of the shares will be carried over into the merger. And that's what being highlighted in the last stage, the third stage. The other thing this article actually shouted out is often after the merger, the SPAC will only have 35% of the ownership of the target company or the combined company. So that actually create a lot of dilution for if you are a SPAC shareholders that you bought during the IPO process and hold it through the or after the merger. That's the other thing we're going to mention in more details. So basically, based on these stages, the earlier you get into the SPAC name, the better, because the starting price right now is $10 a share, right? Based on the current rules and legal compliance. So the earlier you get into it, the higher the chance the SPAC price is going to go up from there. Occasionally, we're going to see SPAC name drop to like $9.7, $9.9 a share, but it barely or almost impossibly going to drop below $10 unless there's any legal issue that we don't foresee right now, or for that particular SPAC, I mean. So what are the dilution factors of a SPAC name? So first is redemption that we mentioned earlier. So here's an example based on this research. On average, the target company ownership of SPAC shareholders after merger, based on the 47 SPACs in this study they included in 2019 to 2020, is 40%. So that means if you hold a SPAC shares and you're the shareholder, after the merger, you will only own 40% of the combined company. So that means your ownership of the SPAC stock, the ticker, will have 40% or 60% of the dilution. You will only have 40% of the combined company's value or valuation. So here I'm just putting a CCIV as an example. Today is February 19, 2021. The rumor is Lucy Motor and CCIV are confirmed going to merge. Right now, based on Bloomberg's news, the Lucy Motor is shooting for $15 billion of valuations upon this merger. And currently, based on the study, on average, 40% of the valuation will be left for the SPAC name. And if Lucy Motor's 15% of the valuation, 15 billions multiplied by 40%, you will have 6 billions of valuation for CCIV after the merger. And currently, CCIV has outstanding shares of 207 million shares. And so based on that, we can divide it 6 billions by 207 million shares. We'll get $29 a share. However, that's just based on this study and the really quick math. I do think Lucy Motor has a very bright future. So, and with all the retail support, very likely CCIV upon merger will be traded above this price. But yeah, based on the historical data from this study, yeah, it's just a quick math. CCIV might actually worth $29 a share. The other dilution factor that you should know upon redemption, and also one thing about redemption is we don't know, and no one can tell you how many redemption will happen upon the merger. It's totally up to the investors, right? They have 100% right to choose whether they want to redeem or not redeem their stocks. So that's one big risk if you want to carry over your stocks after the merger. That's one thing you have to confirm. And also, I see a lot of YouTubers shouting out their target price. I don't know if they just want to simplify their YouTube video or they don't even know the fact about redemption. But if you're watching this video, I want to make sure that I won't shout it out a target price for MoneyPigTrading without considering redemption. That's why I'm always very conservative when I offer a target price for a SPAC name because of this redemption. The second thing you should know about the dilution factor is about the underwriting fees. Even SPAC, they have a certain amount of underwriting fees, very depends on the SPAC. So that will also cost quite a bit in terms of the cash proceed for SPAC name and causing some dilution as well. The third factor is often ignored by a lot of shareholders of a SPAC name is the warrants and the rights. For a SPAC, the warrants are always $11.5 shares per unit price. And the rights for the warrants are ranging between one warrant to redeem 1/4 to one share. So it really depends on the SPAC name, how they want to define the warrant. But based on this study, that's the typical range for a warrant, and the price is always $11.5 share per warrant. And the other thing you have to notice about warrant is not like common stock for SPAC. a warrant is not subject to redemption. And also, the warrant usually have a certain period of time to allow you to exercise your warrants, especially after the merger. So that's one thing. If you want to buy a SPAC name, you have to go to the SEC filing, look at their S1 form or any other forms to look at those underwriting fees, warrants very carefully, especially about the warrant ratios, and also what are the exercise period or deadline of warrants, because that often will, after the merger, the warrant exercise deadline coming up, if the warrants consist a lot of shares that can be redeemed or exercised, and that will dilute the common share pool that could often pull down the common share price of the target company, right? Who holds the dilution bags, right? So in this study, they actually provide a really interesting insights. So they actually looking at the 13F filings. So those are the institutes or individuals who are own a certain amount of assets. I forget the threshold. They have to report that they actually own the stocks. So based on this public information, they are able to pull out throughout the 2019, 2020 SPAC names, and they found out that, so I just put average institute ownerships based on their research, that post SPAC IPO, so that means after SPAC IPO, 82% of the common shares of a SPAC name is owned by institutes. And before the merger, 79% of the common stock ownership of a SPAC is owned by institutes. However, they calculated that 75% of the institute will dump their share right before the merger. So after merger, I calculate that based on their numbers, probably only 20% of the SPAC common shares are owned by institutes. So pretty much institute actually own a lot of stocks, and they pretty much dump it right before the merger. And here's another chart table. I got it from this study, which I find it very interesting. You only need to look at the highlighted numbers. And that is to showing you HQ stands for high quality. So they define the high quality SPACs are the SPACs that are being run by S&P 500 senior officers or former senior officers or funds with more than $1 billion of assets. So those are considered high quality SPACs. And based on this, 3 months after the merger, the mean average return for SPACs, for high quality SPACs, is 31%. 6 months after the merger, this average return will drop to 15.8%. And 12 months after the merger, between the SPAC and the target company, this high quality SPAC average return will actually drop back to minus 6%. So this pretty much tell you the institute dumped the bag right before the merger happened. And after the merger happened, if you hold through the merger, most likely you will lose money, even with a high quality SPAC. If you look at this high quality SPAC, the numbers are horrible, right? After 3 months after merger, you're going to lose 39%. And 12 months after merger, if you hold through, you're going to lose 60%. Here's one of the SPAC and being merged on January 7, 2021. I intentionally don't want to put out the ticker. So after the merger, on the merger day, it was around $15 a share. You can see shortly after, about 5 weeks after the merger, it dropped from $15 to $10.98. It dropped about 40% after the merger happened. And of course, before the merger happened, it's traded at around $10. That's the SPAC price. But yeah, if you enter around early 10, you're probably fine. Right now, you're just holding at your average costs. But imagine you are the people who actually, investors who bought right before the merger around $15. You are losing quite a bit of money. However, we're seeing some exceptions, like QS. It was merged on November 27, 2021, from KCAC to QS. After merging, the price jumped from $25 to $132, and then dropped back down, and now slowly coming back up. Their warrants are not exercisable until the end of June 2021, if I remember correctly. So that's why there hasn't been a lot of warrants exercisable to dilute this particular stock. We actually have a video shouted out, this QS QuantumScape. We'll also put the YouTube link down below so you can take a look. So last and the most is how to choose SPACs. So in 2020, there are actually 248 SPACs listed. And right now, just shortly about a month and a half, in 2021, there are 144 SPACs been listed in the public market. So how to choose the one becomes very important, right? Because most people probably won't have enough money to invest into all these SPACs. So SPACs is always speculation trade anyway, so why don't we choose the high quality ones to make sure we have the highest returns? So based on this study, the SPACs actually run by the former S&P 500 senior officer. I use CXO, could be CEO, CPO, COOs, or any funds that with $1 billion of assets tend to have better performance. So this is another table I got it from this study. You can see like the high quality, which is the definition on the previous slide, have a way better compared to the high quality SPAC name in each time period, right? Just a 3 months period example, the average return for high quality SPAC is 31.5% after merger. However, for the high quality SPAC, the return within 3 months of a merger is minus 38.8%. One caveat I don't like about this table is, as a statistician and data scientist, I don't see the p-values and any t-tests or any other tests to make sure those numbers are statistically significantly different. Even though the number of SPACs included into this table are relatively low, there are some statistic power analysis that can test the statistical power with this low number of samples. So that's just one feedback I would provide if I'm the reviewer of this peer review article. So yeah, thank you for watching. Just want to shout it out. MoneyPig Trading has a long-term investment membership. In 2020, we have outstanding investment results. We actually traded about 40 tickers, and our winning rate is a staggering 89%. So we won all 3 tickers that forced us to stop loss when the market was a little choppy, and our average return per trade for 2020 long-term investment was about 19%, which is really decent. Again, if you haven't followed us, make sure you like the video and follow us on YouTube, MoneyPig Trading, and same with Twitter and Instagram. Thank you for watching. I will see you next time.